Oh, this one's not a joke. This one's the real mess. The metal that gets dragged to the dance floor by interest rates, thrown into walls by inflation headlines, and kissed on the forehead by geopolitical fears, all in the same week. Welcome to one of the most beautifully dysfunctional instruments in the market, a financial mirror ball spinning in sync with the entire damn macroeconomic universe. Forget price for a second. No, seriously, forget it. Because if the only question asked is where's it going next, the game's already lost. It's not about where it's going. It's about what's pushing it there, and when, and why. Otherwise, it's just drawing hope-shaped lines and waiting for disappointment. The problem? Most of what gets paraded online about this metal is utter garbage. A few moving averages, a Fibonacci retracement, maybe a wedge or two, and voila, predictions from someone who couldn't define real yields if held at financial gunpoint. If it were just about charts, the hedge funds would be running MetaTrader on iPads from Bali. Here's the truth. This instrument does not trade in isolation. It is chained to a hydra: interest rates, inflation data, the United States dollar, central bank policy, bond market flows, and industrial demand. And not a single one of those forces gives the tiniest damn about technical setups. Why does this matter? Because there are people right now risking money without tracking Treasury yields, without watching CPI forecasts, without understanding the relationship between DXY and real asset correlation. That's not trading. That's willingly lighting money on fire and posting screenshots of it afterward. Let's assume a case. Inflation data surprises to the upside. Markets freak out. Rate expectations rise. Yields spike. The dollar gains strength. Now what happens? This metal gets smacked like it owes the economy rent. Safe haven demand disappears. Real yields climb, eating into the appeal of holding non-yielding assets. But people still act surprised because their triangle pattern looked valid. Flip the script. Inflation comes in lower than expected. Fed leans dovish. Dollar loses steam. Risk on mood kicks in. Suddenly, this metal gets treated like royalty. Price jumps. Flows rush in. But was it the RSI bounce? No. It was the fundamental shock. A recalibration of future rate assumptions that changed everything. But sure, blame the breakout. Here's the intellectual crime. Too many traders treat this instrument like a technical commodity, but forget it's also heavily used in industrial production. That means real economic demand, not just financial hedging. Green energy, semiconductors, solar panels, electronics, all of it eats into supply. So now throw in a supply-side disruption like a mining strike or export ban, and guess what? Price doesn't care what the chart looked like the day before. It gaps. It runs. It turns into a beast because context patterns. Professionals understand this. They track mine output. They listen to central bank speeches line by line, not just the headline tweets. They dig through ETF flows, options positioning, futures open interest. Meanwhile, retail draws another support line and calls it strong. That disconnect, that's where the money goes. Not to the dreamers, to the ones doing homework while others are still trying to figure out why their trend line broke like a wet noodle. Want some sarcasm? Fine, let's do this. Someone once said this metal usually respects key levels. Cute. So does a drunk uncle, until he doesn't. This asset doesn't respect anything. It behaves when macro lets it behave. It acts tame during periods of stability and then turns into a raging toddler when data hits the fan. Technicals help, but only if used as a language to interpret macro-driven behavior, not to guess the future like it's a horoscope. Another joke? Try this. It's breaking out. Cool. But did the breakout follow a central bank meeting? Was it front-running CPI expectations? Was it seasonal demand? Or is it just wishful thinking on a 4-hour chart? If the answer is not sure, then congratulations. The market thanks that kind of thinking for the liquidity. Here's what stings. This metal has been manipulated more times than a bad reality show script. Look up spoofing scandals. Look up bank settlements. Still think price action is some sacred reflection of supply and demand purity? Nah. Sometimes it's just algorithms dancing with market makers and laughing while retail stares at candles like tea leaves. Assuming someone's still listening and not offended by now, good. That means they're the target audience, the ones who want the ugly truth. The ones who know that real edge doesn't come from clean setups, but from having enough mental ammo to understand what really moves markets. Still want to trade it? Start asking harder questions. Not what's the trend, But what would cause it to flip violently? What event? What speech? What print? What surprise would rip through positioning and throw price across the screen? That's how the professionals think. Not like fortune tellers, like strategists, like financial mercenaries. This metal isn't evil. It's just misunderstood. It's not designed to punish. It's designed to reflect pressure, global pressure, economic pressure, political risk, supply bottlenecks, demand spikes, currency wars. It reflects all of it. In real time, sometimes violently, sometimes slowly, but always in context. If context is missing, so is the logic behind the trade. So maybe next time, before chasing a candle or plotting a dream line, the better move is to open the macro calendar. Read the forecast, look at open interest, ask what's priced in, not what looks nice. Traxing doesn't exist to tell bedtime stories. It exists to slap, to cut, to remind the brain it was built to think, not blindly follow. The visuals are gone, so the signal can be loud. Black screen, pure insight, no distractions, no show, just mind versus market. And hey, if it's offensive, so be it. Language here is rude on purpose, words chosen not to coddle, but to wake the senses, because comfort never taught anyone how to survive in a system built to rob the unprepared. If someone needs kindness to learn, there are courses for that. If someone wants the raw meat, the ugly math, the uncomfortable genius, that's what this is. Final word, this market does not care. It does not care about anyone's bias, hope, or Fibonacci dreams. It only cares about balance, supply and demand, flows and force, information and mispricing. That's it. Everything else? Theater, noise. So go ahead, draw the lines, use the tools, but for the love of strategy, make sure they're backed by something real. Data, logic, narrative. Otherwise, the only outcome waiting is a blown stop and another broken account to blame manipulation for. And maybe, just maybe, next time someone asks what really drives this instrument, there's finally an answer that doesn't include the words, "It looked bullish." Welcome to Traxing, where the truth is ugly, but at least it's real.